Hello, it's ChewDog Charts. Rara avis in terris nignoque similima signo. Black Swan Theory. It's a metaphor used in the stock market that describes an event that comes as a complete surprise, has a major effect on the stock market, and is often inappropriately rationalized after the fact and only with hindsight. But as we also know, these events can be discovered. It's just that most will likely ignore the warnings. As we also know, there is overwhelming evidence suggesting a major economic event will occur within a relatively short period. By this time next year, we may well have had another 2008-2009 style global economic and financial market crisis, and we will do so despite recent assurances by the government that we would not have another such event within our lifetime. There are two basic reasons to fear another full-blown global economic crisis. The first is that we have in place all the ingredients for such a crisis. The second is that due to major economic policy mistakes by both the Federal Reserve and the U.S. administration, the U.S. economy is in danger of soon overheating, which will bring inflation. That in turn is all too likely to lead to rising interest rates, which could very well be the trigger that bursts the all too many asset prices around the world. A key ingredient for a global economic crisis is asset price bubbles and credit risk mispricing. On that score, today's financial market situation would appear to be very much more concerning than that on the eve of the September 2008 Lehman bankruptcy. At that time, asset price bubbles were largely confined to the U.S. housing and credit markets. Today, asset price bubbles are more pervasive and in evidence around the globe. It is not simply that global equity valuations today are at lofty levels, which have been experienced only 3 times in the last 100 years. It is also that we have a global government bond market bubble, the serious mispricing of credit risk in the world's high yield and emerging market corporate bond markets, and housing bubbles in major economies like Canada, China, and the United Kingdom. Another key ingredient for a global economic crisis is very high debt levels. According to the IMF estimates, today the global GDP to debt level is significantly higher than it was in 2008. And in fact, over the past few years, Italy's public debt has risen now to 135% of GDP. That in itself has to raise the real risk that we could have yet another round of the European debt crisis in the event that we were to have another global economic recession. The reason for fearing that the U.S. economy will soon overheat is not simply that it is currently at or very close to full employment and growing at a healthy clip, yet we still have an extraordinary degree of monetary and fiscal policy stimulus at this very late stage of the cycle. Today, in the face of an overheated U.S. economy, the Federal Reserve has an unenviable choice. It can either raise its interest rates and risk bursting the global asset price bubble, or it can delay its interest rate decision and risk incurring the wrath of the bond vigilantes who might sense that the Federal Reserve is not serious about inflation risk. In that event, interest rates are apt to rise in a disorderly fashion, which could lead to more abrupt deflating of the global asset bubble. Now, this information is all well known and has been discussed at length several times. But what are some of the other problems that are not well known and could be considered black swans that may trigger a stock market collapse? Well, let's take a look. Just a few days ago, Steve Wesley, who is the former California controller and CalPERS board member, and CalPERS is the manager of the largest public pension fund in the U.S., Mr. Wesley made a stunning admission, and I quote, "The pension crisis is inching closer by the day. CalPERS just voted to increase the amount cities must pay to the agencies. Cities point to the possible insolvency if payments keep rising, but CalPERS is near insolvency itself. It may be reform or bail out soon. Mr. Wesley was likely referring to an editorial laying out the quote unquote essence of California's pension crisis exposed last week when the $350 billion California Public Employees Retirement System made a relatively small change in its amortization policy. Specifically, the CalPERS board voted to change the period for recouping future investment losses from 30 years to 20 years. While this may not sound like much, the bottom line is that the government would require the California state government and thousands of local government agencies and school districts to ramp up their mandatory contributions to the huge trust fund. Currently, client agencies, such as cities in particular, are already complaining that the double digit annual increases in CalPERS payments are driving some of them towards insolvency. The new policy, which kicks in next year, will raise those payments even higher. The CalPERS system, once more than 100% funded, now has less than two-thirds of what it would need to fully cover all of the pension promises to current and future retirees. The trust fund lost about $100 billion in the Great Recession and never has fully recovered. Were the system to experience another big investment loss, it would pass a point of no return and never be able to pay for pension promises. The options boil down to either taxpayers get the shaft or public employees see their pensions drastically reduced. Now, this may not seem like much, but this could be a shock to the market and could be a black swan. Let's go to the next black swan. As the Federal Reserve reported recently, U.S. consumer non-mortgage debt has never been higher. As of December 2017, U.S. households had a record $1.0 trillion of credit card and revolving loans, a record $1.3 trillion of auto loans, and a record $1.5 trillion of student loans. Among these, the credit card and auto loans in particular have been experiencing accelerating delinquencies. As a result, finance companies and banks have been increasing bad debt provisioning to build balance sheet reserves due to expectations of rising defaults. And this chart here, you can see, shows the net charge-off rates for credit card companies. And DFS is Discovery Financial Services. COF is Capital One Financial, AXP is American Express, and SYF is Synchrony Financial. And each of them has been moderately increasing their level of charge-offs. So let's go to the next chart. While all major credit card companies and banks are experiencing increasing credit costs from the low in late 2015, one can easily see that the increase in charge-offs and costs is only moderate. And as the chart shows, modestly rising net charge-offs for the entire U.S. banking universe increased from a trough in the fourth quarter 2015 at 2.9%, which coincidentally was the same quarter the Fed executed its first interest rate hike of this current business cycle. And as you can see, the troughs in the net charge-offs preceded large corrections in the stock market. So, why is the gradual increase a lack of concern? Well, the answer is simple. The larger U.S. banks that dominate the credit card issuance have focused on prime and super prime consumers following the great financial crisis and have enjoyed a relatively long period of low charge-off rates. Since 2015, the Fed has progressively raised interest rates and net charge-offs at the large banks have started to rise from a relatively low base. The net charge-offs were 3.6% in the third quarter of 2017 and are closing in on a 4% rate, a level that matched the end of the previous business expansion in 2000 and in 2008. So this is where the information starts to get interesting. Let's go to the next chart. And this is a chart of the banks that are not in the top 100 banks in the country by asset size. And it's here in America's smaller banks. They've experienced in just the most recent months a surge in net charge-off deterioration, which at the current level of 7.9% is on par with the last financial crisis. In other words, to find where the next consumer credit crisis may be and may erupt next. Ignore the big banks and focus on the smaller one. Now, it's entirely possible that in the next few months or so, the net charge-offs at larger banks may rise. However, we haven't seen that yet. So looking at this chart here, are the smaller banks the domino or the first domino to cause the collapse? Are the smaller banks the black swan? Well, only time will tell. But I can promise you, we are going to continue paying attention to this. So for today, that's ChewDog Charts. Thank you.